Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. Investor Coaching Show, I'm Paul Winkler. We talk money and investing and financial planning and whatever happens to be in the news or on my mind in a particular week, what has been talked about, and of course there's always plenty going on that I will cover. So getting into it, one of the things I talk about here on the show, the premise, the whole idea, where this whole show started was years and years and years ago. Working for big investment firms, all of us. I was, of course, the person that started it because I was I was in Chamber of Commerce. I was head of I was the president of the Chamber of Commerce, and I was doing this big thing for all of our people that were in the chamber. A marketing thing. I thought, this would be great. Let's just do some kind of a big marketing thing for people because, these are all business owners. They need to learn a little bit about how to market their businesses. And I just knew a lot of people in the area. So I knew people in radio. I had people with SCORE, the service corps for retired executives. So this older people that have retired, have had successful careers, that just want to help out. And this is great. I guess they're still around. But anyway, so... and they'll do this consulting for free for business owners. This is a great little service that they have. These people that were retired, they just still want to give back. So I got some people from there. I got some people that were web designers, back when web designing was kind of a new thing, really. And then I had people in TV and, so we just had this big round table and they're all in my little teeny office. I had this little teeny office where I first started, 566 square foot. And so now it's funny. It's like now 12 locations. Oh my goodness. Anyway, so it was, I'm just blabbing about investing. And one of the guys in there goes, whoa, that's like really interesting. Because my take on investment markets and investing comes from having been in the industry for so long and seeing all the garbage that the big investment firms, investment providers, annuity salespeople, capital investors and all, these people are engaged in processes that I look at as just completely counterproductive. And so often at odds with what the academic research says. So I'm just spouting about that. And this guy goes, you ought to be doing a radio show. So I said, that's kind of, I like that idea. How do you do that? And he said, well, you go talk to a program director. And I made that call. And the guy goes, we don't take stuff like that. So, I went and I called. I says, well, who might? And he said, no, there's another station. So, he led me out to this other station. I call up the station. And the guy's, I got a half-hour slot for you. So I started a show on Saturday mornings from 8:30 to 9. And all of a sudden, I got a call from the original station, new program director in town, listened to the show and said, hey, love to have you on here, blah, blah, blah. And I said, great, great. Went in there, talked to him about it, and the rest is history. Well, the whole idea and the thing that I teach about is that so often, so much of the garbage that you hear about investing is just blowing wind. I had a guy tell me this week, we were talking about Chicago, and I said, yeah, windy city. And I said, wind. I said, I've been there. It is windy. He says, well, that's not how it got its name. And I said, really? And he says, no. He says, the politicians, windy. And I said, I hadn't heard that one, but okay. But, in the investing industry, you got a lot of windy people too. It's just so much of what is taught. Hey, look at what's going on with this stock, this mutual fund here, this fund manager is really, really good. And, you got to watch out for what tax rates are going to do because this is what's going to happen in the future and then, this is what's going to happen. Trump's going to do this. And you got to make sure that you're really looking at this particular area of the market. Oh my goodness, stock market's at record highs and you got to watch it because it's going to crash because there's record highs or, the market's really, really low. And, small caps are they're going to be coming back and value stocks are undervalued right now and blah, blah, And, you hear, value, not growth. I heard a commercial the other day. And I was like, no. That goes against the idea of diversification to sit there and say that kind of stuff. But, so much of what we need to know about investing, we already know. It's not that we don't know that we should diversify. It's just that so often these voices and these siren calls, literally in my office, I have this painting And Ulysses, you have we call the Ulysses contract, which is, tie the person to the post so that when the sirens come calling, remember the old, story, the sirens, the beautiful women were flying around, blah, blah, blah. And he would be tempted. So he wanted to hear their voices, but he didn't want to be tempted. So he tied them to the post of the ship. And all the people rowing the ship in the famous painting have, either plugs in their ears and, so they can't hear it and they wouldn't be tempted. Well, he wanted to hear it. Well, the siren calls that we have around us are all these voices telling us what's going to happen, where things are going to go, what tax policy is going to be going forward, who's going to be doing what. And you need to be, converting everything over to Roth IRAs. Matter of fact, I got a story about that a little bit later. You hear that kind of stuff, and it's like, that is just one-size-fits-all advice doesn't fit anybody. Or you need to use this, guaranteed income in retirement. You need guarantees. And I go, wait a minute. There are a lot of problems with your way of getting guaranteed income. In fact, I'm writing a whole book on that. It's a little booklet. It's not going to be a really long book on the myths of getting income in retirement. But anyway, so, I have this thing that I had as an idea, and I wanted to get out there and teach it. And the idea is stop it. You don't know the future. You can't predict where things are going to go. Matter of fact, the reality of it is that people we throw darts at the stock tables and they beat the professionals. And I'm doing workshop after workshop where I'm having people come in and go, hey, you don't get your sandwich until you throw a dart at the stock table. And for years I did this. And I had people throwing darts at the stock tables and they would beat the professionals pretty much I can't think of a single time when I had this workshop teaching this stuff when I had people throw darts at the stock tables where they didn't beat the professional managers. I mean, it was really pitiful and it was an eye-opener for it, It's you get people to do it themselves and it becomes reality. Kind of reminds me of there was a story of a guy that was trying to sell shatterproof glass. And he goes into the store and he's, selling this shatterproof glass, and he comes back and they have this big convention. And the story goes that at the convention, he was the number one salesperson for shatterproof glass. And, they're all wondering, how did you do this? How did you outsell everybody? And he goes, well, basically what I did is I went into the place that was a potential customer, with a hammer. And I would take the piece of glass and I would raise the hammer up and then I, smash the glass. And they would cover their eyes. They put their hands over their eyes and, thinking that it was going to go everywhere. And when it didn't go everywhere, they were like, whoa, wait a minute. We want some of this stuff. And then they said, well, that's brilliant. So what they do is they issue hammers to everybody in the company that's out there selling. And they go out there and they're selling shatterproof glass like crazy, right? And he comes back and the next year, this guy is the number one salesperson again. And they're like, whoa, wait a minute. You're the number one person again. How did you do it? He said, I handed the customer the hammer. When they did it themselves and it didn't go everywhere, then they were convinced that we had something here. So it's kind of like that. You go and have people throw darts, and when they beat the professionals, then it becomes reality. And then they go, wow, there is something to this. So the idea being that you don't know the future, right? Well, there's an article that came out, CNBC. Why knowing the future is the title of the article doesn't help short-term traders. So even when you know the future, it's a hoot. They said for investors, uncertainty in the market is table stakes. No matter how convicted you are that the market will move one direction or another, there's no way to actually know what tomorrow will bring. But what if you had a proverbial crystal ball? And we do it. In my office, I actually have one. It's kind of fun. We have this crystal ball. And in my office, you walk in and look at my crystal ball. I'll say, hey, ask it what the market's going to do. And then they'll go, ha, ha, they'll laugh. And I go, no, really, look into the crystal ball. And at the bottom of the crystal ball, I have like this little piece of paper. And it says, heck, I don't know. And then people they get a kick out of it. They laugh at that when they do it. But anyway, what if you had one? A recently published study From investing firm Elm Wealth had put this idea to a test with 118 adults, 90% of whom were in graduate finance or MBA programs. These weren't stupid people. They were people in graduate finance programs. In November 2023, participants are given $50 and a chance to trade the S&P 500 and 30-year treasuries based on the information on the front page of the Wall Street Journal 36 hours in advance. I mean, who could lose, right? I mean, 36 hours in advance, you know what the news is going to be. With dollar figures and asset prices redacted. The game, which you can play for yourself online, featured old headlines from 15 trading days, one per year, from 2008 to 2022. In each case, participants could trade as if they knew the future a day before the news broke. I mean, utopia for an investment trader, right? Despite the participants' credentials, the results were dim. About half the participants lost money. Half of them lost money. 1 in 6 went broke. Just like, wow. The average gain just 3.2%. Very, very bad indeed. And, it says, in the article, it says, when reading market takes, whether it's advanced or not, you're getting someone else's opinion, Stovall says, and a lot of times the opinions could be wrong. What's more, even with advanced knowledge, the traders in the experiment were unsure how to size their bets. Their likeliness of being right about a particular move showed no correlation to how much they invested. So they were flying blind, even with the news. For the average investor, it's generally smart to avoid trying to time the market over the short term. Instead, rely on long-term historical trend of the broad stock market to help you build wealth over time. So I like this line for a really, really odd reason. Now, number one, they said for the average investor, for any investor, I mean, literally what we know about research, it doesn't matter. People do not have this ability. And the reality of it is one study showed that you'd need like 60 years of data to figure out whether somebody's outpacing the market or getting higher returns in the market was due to skill or whether it was due to luck. So perish the thought. I mean, it's just forget that particular line. But it says it's generally smart to avoid to try to timing the market. I would say it's always smart to avoid timing the market because studies of pension plans, they had like 91 of them. And when they engaged in this activity, 100% of the time, they actually hurt their returns and increase the risk. So it just doesn't make any sense. But here's the line I like in here. Instead, rely on the long upward historical trend of the broad stock market to help you build wealth over time. A common question I get, because sometimes people, they'll hear me say, looking at the past performance of an investment, it's just, you don't invest that way. You hear people invest based on 1, 3, 5, 10-year track records, right? And you look at funds and look at the track records and you pick the funds that had, good track records. And I'll often point to a stock market chart and say, hey, where did this thing have a good track record? And somebody will look at it and go, well, right here to here. Yeah, great. What followed that? And then you see the market go crash down. And you go, well, yeah, track record really helped you there, didn't it? And I'm like, no, that's crazy. Why do people teach that? Well, because it sells. I can get you to buy something with a good track record because you believe that it will continue into the future. So it's easy to get you to buy something. Let's say if you've had a market downturn or if you've had, let's say, a little bit of softness in the market. And people say, oh, here's this market's really solid. The market could crash. You better go get your money and put it in fixed income investments. And you go do that. And then the market goes up and you go, oh, gee, that didn't work. But, the person that was selling that fixed income investment, yeah, they made off. They're fine. You got hosed, but they're fine. So using past performance is just a waste of time because markets move in cycles. Now, you go, okay, so why do they use it? Because it sells. But you look at that and go, well, what on earth do you look at? And that's where they're hitting on it right here. And they're talking about rely on long historical. So when we look at long historical returns of asset classes, what we know is that small companies historically outperform large companies over the long, long run. So we know, hey, we probably need to have small companies in our investment portfolio. and value companies outperform growth. So we need to have some. Now, do we time it and try to say that it's going to do well in the next 5, 10 years, or even 20 years? No, you don't know. I mean, 17% of 20-year periods, large companies outperform small companies. So the data is not going to be that it's not going to be consistent all the time where you know that something that long run tends to work, small companies outperforming large, is going to happen, or that value outperforms growth. Now, 96% of 20-year periods, as you may have heard me say before, value does do better than growth. But you have these short periods of time, it could be growth is outperforming value for 4, 5, 6, even 10 years. So you got to be really cognizant of the fact that you don't know what's going to happen. And I just love that this article just tore that apart. Now, at the end of the article, it says something that I was just like, oh, no, forget that. That's why if you want to get your blood pumping, try to figure out what will happen next in the market. It may make sense to designate a small portion of your investments to have your fun wheeling and dealing. How about go and have fun wheeling and dealing and hanging out with your family, going out to dinner or going skiing or, maybe bungee jumping or whatever you want to do. But throwing your money and gambling it based on some prediction about the stock market, why would you make Wall Street richer than it already is? They love it when you do that kind of junk. They love it when you engage in that activity. I don't think it's such a good idea. It says you're doing it for entertainment is how the article ends. It's reminds me of Burt Malkiel. Or no, it was Bogle, I think it was that said, he called it investainment. I think there are better ways to entertain yourself than gambling in the stock market. Okay, so I thought it was kind of a hoot. I'm looking at watching TV this morning, and the whole thing, it seems like every show I've got to at least talk about it for just a few seconds anyway, and bear with me. But we've got to talk about Bitcoin as an investment because I keep getting the question, what about Bitcoin? Bitcoin, what about? And if you never heard the show before, well, you'll probably wonder why I don't like that as an investment. It's because investments have to have some kind of a payment. Somebody's paying you to use your money, whether it be through interest, whether it be through earnings of companies, whether it be rent, like in real estate or something like that. But there is no payment in something like Bitcoin. There's no payment in gold. Take an ounce of gold 100 years ago, you could buy a good men's suit. Today, you could buy a good men's suit for an ounce of gold. Not an investment. But people do. They speculate on lots of stuff. They try. I like speculating on things. I want to guess. I want to figure. I get an adrenaline rush, and I'm like, there are better ways to get an adrenaline rush. That's not my thing. But there was a famous investor, well-known guy, being asked about Bitcoin. And I thought it was just, it was a hoot. It was, I think it was Jamie Dimon that was asked this question. And I love the people on the Financial Channel talking about his answer regarding this. Check this out.
Yeah, my favorite moment, I think, was when Andrew tried to get him to talk about Bitcoin, and he said, I'm not talking about Bitcoin. You guys talk about it plenty, just like you used to talk about AOL all the time.
That's funny. I mean, you just listen, and it was funny just to hear them go, ouch, after that comment. You used to talk about AOL. Now nobody's talking about AOL. And you think about it, companies come and go so rapidly today. It's not like the good old days where, companies would last on the S&P 500 for 50, 60 years. Now you have companies that last on the S&P 500 for 18 years. And the companies that were really hot, I talk about the ones that in the past that have come up with great technologies that are just phenomenal, earth-shattering. We use them like crazy, weren't necessarily the companies that benefited from those technologies financially. But that's kind of Wall Street. Hey, what's the exciting thing of the day? You guys talk about Bitcoin every year, announcing what it is. And that's just the thing. You watch the financial channels, and they're on there telling you what the price is. And then you see it go up. You see it go down. And it's almost, you get this idea, them announcing it makes it seem like, well, maybe it is an investment. Look at, they're tracking it every day. Why would the financial channels track this if it weren't an investment? Indeed. Why wouldn't they? But, the other thing that happened this past week that calls into question really the legitimacy of whether Bitcoin or any kind of currency like that is really an investment was the Trump meme coin. And they talked about that as well. Check this out.
Because now the conversation around Bitcoin is, does this Trump meme coin actually hurt the sort of legitimacy, the fact that it's attracted so much money on just pure speculation? Does that say something about Bitcoin overall? I think that's sort of where the conversation has moved around Bitcoin.
Yeah, I think it's so right on. You come out with this meme coin and it just balloons in value like crazy. Why? Why did it balloon in value? Was there some underlying value there? Like where you were going to, when you buy a stock in a company, you are the owner of not only their assets, you're an owner of their earnings from here to eternity. And they may have a product that could have some great earning potential. It might have huge demand in the marketplace. Or let's say that you buy a piece of real estate and maybe when they finish with that thing, there is going to be a huge demand, maybe a big apartment building or something like that. And there's going to be a huge demand for people to pay high rent in that particular complex because of the amenities that are in that particular complex or whatever, or the location or whatever. Then you could look at that and say, yeah, this place has value. There is something here, and there's going to be a cash flow coming in for years to come. But if we're looking at something like a commodity, you're going, well, what's it worth? It's worth what somebody will pay you for it. Can I get somebody to pay a higher price than I paid for it? It's precarious. I mean, you're literally on shifting sand, and that's the point that they're making here. I think it's great. I'm glad that some people are pointing this kind of stuff out right now because it's long, long overdue. I think that too many people are getting pulled in and they are trying to get rich quick on something because they've seen it balloon in value. They've seen other people do well. And it's that FOMO thing, fear of missing out. And now they're looking around and go, well, I don't want to be left behind. I don't want to be the only person that doesn't have this. Oh my goodness, there's only so many of them around. And, it's limited supply and the demand could be, huge. Well, what did they just do? They came out with another type of meme investment, another commodity, the Trump meme coin. And all of a sudden there was demand for that. And the question is, could it go, well, wait a minute, this may be questioning the legitimacy of this in the first place, just by how this ballooned in value on its own. And there are too many people, I find way too many people. And I go back many, many years in this industry, and there were too many things that I had seen in this industry, in the financial industry, that look like, oh, that makes a lot of sense. Oh, that's really great. And then we forget about it years later. We tend to push it out of our minds, the mistakes that we've made. But there are people that are genuinely struggling in retirement now that could have been multimillionaires if they had not fallen for some of the things they had fallen for. And that's just my point. Just making sure that you just don't fall for things that don't make a whole lot of sense. Now, when do things change? When does it tie? I have no idea. It's gone a lot longer than I thought it would, and a lot longer than a lot of people thought it would. But you just do not know when people will all of a sudden go, whoa, what are we doing? What are we doing? You just don't know when that'll happen. But recognize that investing isn't something that should be just fun and exciting. And it ought to be kind of boring. When I own things, I own companies, and I'm not changing them around all the time. I'm broadly diversifying across, tens of thousands of companies. The problem is most mutual funds, you think, I'm diversified, I own a mutual fund. You might only own 40 stocks in that mutual fund. Do you know even how many stocks are in the funds you own? Or if you do own some of them, matter of fact, one of the funds I'll talk about in just a second here owns a lot of stocks, but almost all the money is in just a few companies. And that's something that's happening a lot these days. Do you even know how many stocks you own in your portfolio? Do you know if the different funds that you own different stocks? I see people all the time. They bring in a portfolio. They say, hey, can you take a look at this? And I'll look at it and go, whoa, wait a minute. You got 8 funds. And all 8 own Microsoft. All 8 of them own Apple. All 8 of them own NVIDIA. And you go, whoa, are you kidding me? I didn't realize I had that same stock in every one of my funds. And here's where it gets me. I often I'll point this stuff out to people. And it's almost like what's going through your mind. They must be doing this for a reason. And I go, whoa. That blind trust runs deep. People really do blindly trust these big investment companies. And my thing is, please use your own brain. Don't be fooled into thinking that you can't get this, that you're not smart enough. No, you are. Just use the common sense to recognize if all of these things own the same stuff, there's something wrong here. Recognize that you know more than you think you know when it comes to investing. And that's what this show is about.